Hey guys, Sandy Guide with Harbor One Mortgage, back with another FAQ. What is PMI? PMI is private mortgage insurance, and it is required pretty much most of the time, unless you're doing like a special program, if you are putting less than 20% down on the purchase of your home. PMI is issued by an outside company, so a mortgage insurance company, and it's basically an additional insurance for the lender for the additional risk that they're taking, lending you more than 80% of the value of the home. Also, when lenders say PMI, they should be talking about a conventional loan and not a government loan. If it's a government loan, they should be calling it MIP, which is mortgage insurance premium. So for conventional loans that have PMI, if you did nothing on that first mortgage and you just kept paying it down, once it naturally gets to 78% of either the original sales price or the appraised value, whichever was lower, then the PMI naturally falls off. If, however, you want to remove the PMI sooner than the natural course of it, the balance going down to 78%, you have a couple of options. So the first option is that when it gets to 80% of the either appraised value or sales price, whichever was lower, you can call up the loan servicer and ask them to remove it. And they will. But I mean, 80%, 78%, that's pretty close. If you want to remove it sooner, there is a way to do that. So as most people are aware, home values typically go up over time. Depending on how fast the value goes up and how fast the loan balance goes down, you may reach the 80% loan to value point way faster than if you just waited for the loan balance to naturally come down. So if you wanted to remove the PMI earlier than the natural time frame that the balance will come down to the 80%, you can call up the loan servicer and ask them to do a new appraisal to see what the current value of your home is. You will need to pay for this appraisal, but if the appraised value comes in high enough to where now the current loan amount is 80% or lower of that new appraised value, you can possibly remove the PMI if the loan servicer agrees to it. However, if they don't agree with it, you can still probably remove it just by refinancing. So if you go to refinance, it's going to be an application. The whole process is going to, start all over again. And you don't have to choose the original loan servicer. You can basically go to any lender and they are going to go through the process. You're going to apply the whole thing, pull your credit, and then you will get an appraisal and they will know your current loan amount. And as long as the value comes in high enough to where your value is at 80% or lower, no PMI. So I want to show you a quick example using real numbers so you can see what I'm talking about. Say you buy a house for $350,000, you put 5% down, so your original loan amount is $332,500, which is a 95% loan to value. Say you make 24 payments just on the regular schedule. After 24 months, your balance is going to be $324,081. So you take that balance, divide it by the original $350,000, and your new loan to value after 2 years is 92.6%, which is above the 80% requirement, so you cannot remove PMI yet. But say you apply for a refinance, you get a new appraisal and it shows that your home is now worth $406,000 after 2 years. You take the loan amount of $324,081 divided by the new value of $406,000, and your current loan to value is now 79.8%, which is under the 80%, so no PMI. Or if you didn't want to refinance and you want to just wait the natural course of the loan being paid down according to the original amortization, you'll need to be below 80%. So you'll take the original sales price of $350,000, multiply that by 80%, and your loan balance will need to be under $280,000 for you to remove PMI. So looking at a regular amortization schedule with about 6% rate, that would take you about 117 payments. Or 9.75 years.